Hello, I'm Tony Kaye, the editor of Eureka Report. I'm joined by Evan Lucas, our market strategist for the Economic View. Welcome, Evan.
Hi, Tony.
Evan, today I just wanted to talk about a couple of things. Firstly, what's happening with the Aussie dollar. Secondly, what's happening with interest rates.
So, yeah, it's what a story. I mean, we're talking about Aussie dollar sitting at 2.5-year highs. It's punching through and looking like even going towards 79.5, and that's an amazing scenario considering where we were 18 months ago and the fact that we were talking about Aussie even possibly going into 69 cents.
Absolutely.
So it's a real big story. I mean, from an actual sort of currency pair perspective, you probably need to put it down to the fact that it's a US dollar side story. So there's always two sides to a coin, and in this it is actually the US dollar. And the reason for it is around interest rates, as you alluded to, and it's interest rates in the US. If you have a look at dot plot expectations, and we've got a chart that will show you that, you can see that the median range for the end of this year is between 1.25% and 1.5%. Current range is 0.5 to 0.75, so that means at least another rate rise up. However, if you look at market pricing, you can see that the expectation of a rate rise in the US is now below 45% and falling like a stone, and the movement to no movement at all for the rest of 2017 is now pushing towards 60. And that's off the back of Janet Yellen last week, inflation expectations in the US being their second mandate. So looking back at that question around the Aussie and the fact that we're moving towards 79 cents, the US dollar is being sold off in droves, and it's not just an Aussie dollar story. You can look at places like Canada with their rate rise, but you can also look at the euro, dollar and cable on the back of this. So it's a very interesting scenario. The other thing is, look, the Aussie is quite strong, and it should be. China story is very, very positive. If you have a look at the commodity story, iron ore, copper, coal, they're all moving in the right direction. So that is a positive for the Aussie side, but unfortunately it's a US dollar side of the equation.
So what does it mean for investors here?
It does mean a couple of questions around sort of those that have always had a premium on that US dollar tailwind. So those that have really big exposure to US dollar earnings, places like Macquarie, CSL, Ansell to some extent. You can also put Brambles. It also means you've got to look at the commodity story as well from a BHP, Rio, blah, 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 situation, because they earn in US dollars. All of their product is priced in US dollars. So that tailwind they get out of repatriating back into Aussie is probably hit on the back of that. Now, the caveat to that, is this an intra-month scenario, or is this actually a more medium-term movement? If you start to see the Aussie averaging 75, 76 US cents, that will hit the bottom line. If this is a short-term movement and it goes back and mediates to sort of 74, then this will be a small hit, but not a huge one. But if it becomes the norm that the US isn't moving rates, you do therefore need to be cognizant of that, and it becomes a headwind rather than a tailwind.
Is it an opportunity for Aussie investors to get into the US using that slight drop in the US dollar? It
is. I mean, again, when you do that investment, it's on spot rate. So that's, your advantage right now is that you do have a spot rate that's much more attractive. It's at a 2-year high. And exposure to the US market is clearly still and has been the place to be. I mean, you are still seeing US S&P growth, high single digit, touching almost double digit over the last 3 years. And 2017 is on track for the same again. The NASDAQ, look at the growth, because this is the other part of this, is that your exposure to growth in a low inflation world is where you want to be, and the NASDAQ is showing you that. So yes, it gives you that chance with a cheaper US dollar to get that US exposure.
So let's move on to rates now. The Reserve Bank's come out with its policy statement yesterday, and actually saying that it wants to normalise in inverted commas.
And that's the word, isn't it? Normalise. And I think the RBA is certainly part of this trigger in the Aussie dollar side. You've got a very, very neutral RBA, and I think the word is bullish. It's not hawkish, okay? And that's what you use in macro thematics, dovish and hawkish. It's not that. What they are talking about is that they now believe that the normalised rate for the cash rate is 3.5%. That's compared with what it originally probably was, which is about 4.5 to 5%. So that's a downgrade in terms of what that is. But what the market has picked up is the idea that actually that's 200 basis points above where we are right now, and that therefore means rate rises are coming. That's not what they signaled. You've got to remember their mandate is inflation, and trim mean inflation at that needs to be holding between 2 and 3%. We're not there. We're not anywhere near that. And normally if they were to raise rates, it'd be when trim means about 2.5, more likely 2.7%, when it's really starting to shift for them to move. So rates are unlikely to move for at least the next 6 months. I think that needs to be, but it is very clear that they are quite optimistic on the Australian economy. That's a real positive. They do see growth in consumption, they do see growth in private investment, and they do see inflation returning. So that's all very positive. But the minutes yesterday were digested that basically 25 basis point rate rises are going to come very, very soon. That's not what they said. They're just optimistic on the economy, and they now believe that the normalised rate is 3.5%.
They just couldn't afford to put up rates
No, they couldn't.
by that much and that quickly anyway, because it would just totally
It'd kill growth.
scare the market.
Yeah, it'd kill growth. I mean, let's look at it from outside of market perspective quickly. Consumption is almost 50% of growth in this on the GDP figure, and that therefore means consumption from you and I of this world. If you all of a sudden saw your home loan, your personal loan, your credit card rate jump up quite quickly off the back of that kind of movement, your consumption is going to fall through the floor. Now, that also means that looking at what's going on with that, the discretionary space would be certainly some place to watch. You would see if there was a rate rise, it wouldn't just be the banks that people would look at. You have to look at discretionary because that is a massive brake on consumption. So, yes, I'm with you. You're unlikely to see a change in rates for that reason, and household debt's another one. But it is something to be aware of that rates will move. When that is it will happen in the future, but it doesn't look like it's going to happen in the next 6 months.
No, and we've already seen the banks raising rates anyway on mortgages.
Yeah, that's right. And then you've got what's happening at the moment with the APRA regulations, and that also needs to be sort of taken into probably into your sort of overall strategy, is that it's likely that they will start to, again, use macroprudential rules on particularly interest-only loans, and that I think needs to be part of it. So shifting people to principal and interest, and that gets back to that thematic around discretionary stocks. If you're having to pay your principal and your interest rather than just an interest only, that's more capital outlay into your loan rather than into your back pocket for discretionary spend. So that's the other part that is interesting around this. If APRA does increase the amount of P&I loans that they want rather than the interest-only loans, that's another indirect sort of lever on, unfortunately, on consumption. So just be aware of that as well. I think that's the other interesting part out of this is APRA could have an effect on the overall sort of sector thematic.
Well, thanks, Evan. Thanks for joining us on The Economic View.
Thanks, Tony.
Join us again next time.
InvestSMART now offers a life insurance comparison service. All you need to do is answer a few questions, select your cover, and compare the results. This quick and easy service provides quotes with up to 9 of Australia's leading insurance providers. You can compare the benefits of each insurer with our easy-to-use comparison feature. We have a team of qualified specialists who can answer any questions you have and make the application process as smooth as possible. Just visit our website or give us a call.